don't want you guys to be another story like that client who only has $50,000. It's just going to be a disaster. What's prompted me on this week's podcast is phone calls, messages, every form of communication, talking about wanting to set up an SMSF. And for those who don't know what an SMSF is, it stands for a self-managed super fund, but it's like basically a private super fund that's just your funds and maybe a few other people that are closely related to you. So maybe your spouse. And if you're one of these people that's been thinking about, I want to set up an SMSF, I want to provide you enough information to give you the scope and idea about where you can go next and whether it's something you still want to do. Just remember as well that everything I talk about today is general information in nature, and really what you need to do is if you do want to set a self-managed super fund up, you really got to seek out the right guidance and make an appointment with your accountant or a financial planning advisor to get the advice that's tailored to you and your circumstances. If we're not growing, you're not growing. Hey guys, welcome back to the channel. If you are new here, welcome to the channel and thank you for watching. And if you're a regular viewer and you've been supporting our show, big thumbs up for you guys. I really do appreciate the support, love, and the comments, clients, and people who have been watching just saying, hey, really loving the content. And you know what? I do this for you guys. So if you've got any content ideas, please get in touch with me and let me know about what you want to hear about. My name's Nathan Rigney. I call myself the Profit Generator, and I'm all about using business psychology, giving you guys some facts on accounting and bringing a lot of these things together with financial advice and then just practical stuff when it comes to health. And really just a whole well-rounded stuff of what I'm interested in. I'm a CPA, I'm also a certified Profit First professional, and I've been doing accounting now for over 20 years, since I was 19 years old and I'm now 42. So that's a bit about me. All right, so getting back to SMSFs, I'm seeing so many people wanting to set these up. And you know what, with everything you do in life, whether it's an investment or making a choice about whether you go to this restaurant or that restaurant, there's pros and cons in everything that's out there. I want to share stories of things that I'm seeing and just give you guys a little bit of knowledge about a self-managed super fund and how it works. It's like anything from recently a 28-year-old came to me and said that she had set up her own self-managed super fund with a balance of only $50,000, and lovely client. I get along with her and love her to bits, but a lot of knowledge isn't there for running an SMSF. And we're going to get into that in a second. And I think a lot of these stories will come to play and to understand why an SMSF isn't right for some people and then right for others. So with this lady here, her super balance is too low. So typically what happens is when ASIC, who is the regulator, talk about self-managed super funds, they do have actually a benchmark amount that they suggest that is the minimum balance that you should have when you're setting up a self-managed super fund. So we talk about this client here. She only has $50,000 to invest in her self-managed super fund. ASIC actually recommends that you have a balance of at least $200,000. And the reason that they say that is because the setting up a self-managed super fund and then the ongoing costs to run it are actually quite costly, but those costs can actually be reduced as your member balance increases. And we're talking about maybe balances joined together. So if you've got yourself and you've got your spouse or a partner, and maybe if you want to, the kids, assuming that they're working and they're old enough, you could roll all that money in together and collectively you could have your super guarantee from your employer being paid into your self-managed super fund, right? And if that balance grows, that fixed, well, because accounting fees and running costs generally are fairly fixed. So those costs become lower and lower as your member balances increase. So you can see that having a member balance of only $50,000, there's going to have to be a lot of growth in the investment decision that this client, as a trustee of her self-managed super fund, is responsible for getting. And maybe she would have been better off leaving her money in the retail fund, or maybe finding a better fund that suited her performance requirements or based on her risk or her personal investment strategies. So that's one story. And another story I've seen recently, I sadly see a lot of clients where they're heading towards maybe the pearly gates and they're getting a little bit older in their 80s and they just don't really have that same knowledge they had initially when they set up their self-managed super fund. So you gotta remember as a trustee that you're responsible to make all of the decisions of your super fund. If you don't have that mental capability to make those decisions, maybe it's time to exit your funds out of a self-managed super fund and then into a retail industry fund where you can have a professional manage your money for you. Often I see people in their 80s where they've got a fund and it's just now not working for them as well as it used to. And the third story I tend to see as well is that I do see a lot of people who want to set up self-managed super funds where they're very unorganized as people, and that's okay, right? If that's just the way you like. But the thing is that there's so much responsibility with having a self-managed super fund that if you're the type of person that leaves things to the last second and you hate doing taxes, I dare say you're probably gonna hate doing a self-managed super fund accounts as well, because you've got to keep regular minutes on all the things you decide to do as the trustee. And then also you need to now decide on where you're investing the money. A lot of decisions you need to make, and you just can't use the funds as you see fit. It's got to be tied back to the purpose of having a super fund, which is to provide retirement funds. And ultimately, when you go to retirement age, you want to have as much money as you can to retire on. The question that we want to be really focusing on today, our goal is understanding, should you open up an SMSF? Everyone's circumstances are different, but ultimately we want to walk away and go, hey, now I have enough information that I can decide that yes, this is for me, or maybe not so much, and maybe I should look at better or different alternative options. Let's get back into some really key basics, right? Let's just start with what is super? Right, so superannuation was created in 1992 by the Paul Keating government, and basically what it was, employers had to start paying an additional amount on top of your gross salary that went into a complying super fund. And so there's a lot of rules around super, but effectively the whole point was that the government went, hey, you know what, we have this aging population, and the last thing we need with an aging population is a whole lot of people that we need to pay pensions out of. He's had this foresight to see that we needed a system that the government wasn't dependent on having to provide for people's retirement ages. And if we also go back to when governments did provide pensions for our elderly, the lifespan of people when they retired in their 60s was that they would probably only live for another 10 or 15 years. But now people are living beyond that into their 90s. For goodness sakes, like my grandmother, God rest her soul, she just passed away at the age of 96. So you imagine that if the government thought, hey, the average lifespan was only 15 years, but then my dear grandmother lasted until an extra 20 years. And that's why super came about. And essentially what the purpose of a self-managed super fund is, we go back to what I call the sole purpose test. The sole purpose test is that the key when it comes to super is that everything that is there for the super fund, whatever decisions you make, is for the sole purpose of providing funds for when you come to retirement age. When you come to that point where you're of age where you can get a pension, there is enough money to provide for you in those days where you are no longer working and bringing in money. An industry fund is, you've probably heard of HESTA, like CBUS, or a retail fund is, it might be maybe Colonial, might be BT, usually more the banks or the insurance companies that are running super platforms. And really what they are is they've got thousands and thousands of members, and then they have the right systems and processes set up so that depending on whatever type of investment risk you want, whether it might be say more of a balanced sort of risk portfolio or maybe more of a high risk or a low risk, that they have different funds that they go and invest around the world. Essentially, they would have teams of people that have more knowledge that you and I are going to have time to investigate and understand about different markets and different investments, to then make the right decisions about how you invest your money. Whereas if you have a self-managed super fund, you're in charge of everything. You run a bank account that's separate, that's basically owned by the super fund, and you make the decisions on where you're going to invest the money. And there might be limitations about what you can go and invest because you don't have as much money to invest. But essentially, the sole purpose test is that whatever you do in your super fund is in for the benefit of your super fund growing its member balance so that when you go to retire, you have as much money as you need to retire comfortably. So with a self-managed super fund, you can have up to 6 members. And what does that mean? That could be you, your spouse, it could be your kids, it could be other family members, but generally speaking, what I see with most super funds when you set that up, it's probably going to be you and your spouse, husband, wife. And effectively, you can invest on whatever you want to invest in. But there also are limitations. You could invest in art if you want to, and this gets a little bit more complicated, but then there's a lot of strict rules around everything you do when it comes to that investment. You can go invest in crypto, and that's pretty much a whole nother video if we just did crypto in super funds. So what we do see with a lot of clients is that they will go and invest direct into stock markets. And when I say stock markets, like the Australian Stock Exchange, they might invest in shares. And then sometimes what we also see as well is that clients will want to buy property. Now, the reality is that if you create your super fund and the member balances you have from your current funds, they might combine to say maybe $200,000 or $300,000. So if you want to buy a property that's going to cost $600,000, you can do that in super, and you do have that ability to borrow. So that's where a lot of people like doing it, because they might not be able to invest in property in their own name, but they can invest it in super because they've got enough member balance there, and then they might want to have a strategy where they contribute extra super above and beyond what their employer's paying to then have the goal of the super fund owning a property, so that when one day you retire, it's still going to provide a income from that investment. But there's a lot of good options. If you can buy in a super fund a property, so that could be a property anywhere in Australia as an example. What you can do is you can gear it. And so when we talk about gearing, that is basically borrowing against the property, and then it gets a little bit more complicated. We have this thing called a recourse borrowing arrangement, but they are all things that a lot of clients are actually quite attracted in doing, and having a strategy to get to that point where they have a really good investment balance for when they retire. But the key thing with everything when it comes to super is that there are a lot of rules. You can't go and pull money out of that super fund and use it for your own personal circumstances. Even just to borrow the money and then put it back, that is actually a contravention against the rules of running a super fund. You can't decide that you're going to lend some money to a family member. And you can do it to a certain extent, like you can do what you call a 5% of your member balance, but the reality is if you've got a balance of $500,000, 5% of $500,000 is only $25,000, right? So not much you can lend, but then if you do borrow the money, it needs to be on commercial terms. So you can't just go, hey, you know what, I want to use the money for myself, or I want to lend money to other family members. And then even if, say, for example, you go, hey, I want to buy a property and then I'm going to live in it. Nope, can't do that either. And you can't even have a family member live in it. So there's a lot of rules. And the reason those rules are there is because we keep going back to that sole purpose test. Everything you're doing is for the best benefit of the super funds. So if we talk about, say, for example, letting a family member rent out your house because they're related, I guess the way the ATO or ASIC would look at it is that you might give your family member a discount. And so that's not going to be in the benefit of your fund. So every super fund has a lot of rules. We have this thing called a trust deed, which sets out the rules, but then also there's this thing called the SIS Act that governs all the rules of what you can and cannot do in super. It's very regulated to run, and if you don't like regulation and you don't like following the rules, it's going to be very tough for you to then go, hey, what are the boundaries? And then if you step out, possibly you could be putting a lot of your funds, your retirement funds, at risk of being taxed at the highest marginal tax bracket, because the ATO or ASIC looks at your fund as being a non-compliant fund because you haven't followed the rules. So when you want to go set up a self-managed super fund, there's a few things that you need to do. The first thing you need to do is basically have a chat with your accountant, just have a general discussion about what is it you want to do, what is it you're thinking, why do you want to set up a self-managed super fund? And generally speaking, your accountant will have that discussion with you and then work out, well, hey, is it something worthwhile doing? The next step after that is you do need to get a statement of advice from a financial planner or someone who has a limited financial planning license to give that advice. It's very important that you get a financial planner to give you that advice, that tick to say that, hey, yes, we do think you are a fit and right person, where all the circumstances, everything that you need to be to run a self-managed super fund all fit into what's key to help you be in the best place you need to be. So when you set up a self-managed super fund, you need to get a statement of advice from a financial planner. Every financial planner has different costs, but what I see on average is a statement of advice costs around $3,000 to $5,000. So there's a lot of money before you even start. The next thing you need to do is you need to actually set up the self-managed super fund itself. And there's two steps to this. A self-managed super fund is like a trust. And effectively, when you have a trust, it isn't like an entity like myself, like a person or a company. So you need what we call a trustee. And usually what a lot of people do is they have a corporate trustee. So that means we set up a company that is the trustee, and then we also have to set up the self-managed super fund. And then that needs to be stamped and it needs to be signed, and then you go on your merry way to set up your super fund. The next step after that is you need to roll over your funds from your industry fund and your retail fund into your super fund. One key consideration that's vital when it comes to actually setting up a self-managed super fund is looking at your insurance. So typically, if you've had a retail fund or industry fund for some time, there might be an insurance component in that, and that could be anything from even just a basic life insurance policy. Now, if you're in this stage of your life where you might be like me in your 40s, to go and get a whole new insurance policy is going to be a lot more costly because you're older and that you probably have a lot more health risks than what you did when you first started working in your maybe your early 20s. And the reason the insurance you have in your current super fund, because it's such an old policy, it's probably got a lot of those rates, whilst they might have increased, but a lot of those rates that relate to the insurance has probably been a whole lot less costly compared to starting a new insurance policy. So to set up that self-managed super fund, you could be looking at the end of the day, anywhere between $5,000 to $10,000. And then there is ongoing administration costs as well. So with a self-managed super fund, everything gets documented, everything is looked at, and you need to keep proper financial records. So just like operating a company, but it's even more work on top, because now you need to keep records of decisions made in the super fund. You need to also then keep records on investments made, income received, and then also, what the closing balances are every year, and making sure that those balances are actually recorded as owned by the super fund. Being a trustee of a self-managed super fund is that every year you've got to keep really good records, you've got to keep really good files, but then you need to then give those records and files to your accountant, who will then prepare for you a self-managed super fund set of financial statements. And when those financial statements get prepared, it will have everything from every transaction that was done throughout that year. It will have every piece of income that was earned. It will also record whatever, super guarantees you received from your employer. So then you need to get records from your employer to confirm how much you received in super guarantee or other contributions. And then on top of that, you need to basically confirm all the balances of what the super fund's holding. So that could be anything from different lots of shares to property. Even when we do a set of financial accounts for a super fund, if the super fund has a property, we'll go and do a title search to make sure that property is still owned by the super fund. But effectively, all this work gets put together, and then there's a super fund tax return that gets completed. But before it even gets lodged, the next step is it needs to get audited by a registered auditor. And essentially what an auditor is doing is that they're going through all the work that you've prepared and all the paperwork you've kept aside, and then all the work your accountant's done, making sure that you've complied with all the red tape, you've kept to the rules, you've kept to the regulation, you've kept to the compliance, and everything is hunky-dory and all looking good. And then they give you the big tick, that green, yes, it's good for you to go and lodge. But say, for example, you have maybe accidentally taken some money out of your super fund and then put it back a few days later, they might have to write a report depending on the balance and depending on how often you've done it, and we call that a contravention report. So they might have to write a report basically saying that, hey, you actually haven't followed all the rules of operating your self-managed super fund, and I've got to let ASIC know. And you're paying for that auditor to do that. But when we look at all this sort of stuff, the ongoing administration, the ongoing annual costs, the ongoing decisions all the time, it takes your time. And by the way, you don't get paid from your super fund for all that effort and all those things you're doing, but then also the cost of like paying the accountant, paying the auditor, and even just having bank accounts with bank fees and all this sort of stuff. You pile that together, there's going to be a cost. And depending on what you're doing in your super fund, whether it's really basic or you've got a recourse borrowing arrangement, or maybe you're a bit older and you're starting to take a pension from your super fund, running with an audit and doing the accounting and the financial reports could start anywhere of like around $3,000 and could work all the way up to maybe $8,000 or $9,000, $10,000, depending on the size of the super fund. So there's a lot of work that needs to be put back in it, and there's a lot of drawbacks, but there are a lot of benefits as well. Before I get onto the benefits, one thing I really want to make key and get my point across is that if you don't like regulation or compliance or keeping paperwork, but the other thing as well is if you, depending on what you're investing in, if you have no understanding about the investment stock market or whatever you want to invest in, maybe you need to have a look at your abilities and say, is this going to be in the best interest of my super balance? So as an example, I don't understand crypto and it's not really something that I'm really interested in, and I would never invest in it because I don't understand. But if I did want to invest in it, I would make sure that before I've done any investment or taking the plunge to risk my money, that I would do a lot of research and my own due diligence to understand the concepts, understand the investments, understand the risk before I went and done it. And it's the same thing, like if you're not interested in the stock market investing in shares, a great idea for you to then take a role in investing your super into that particular area. You can get people who are guiding you and helping you through deciding where to invest in. So every time I buy shares in my own self-managed super fund, I have a full service stockbroker. I don't go to the online like Comsec broker, for example, where the trade is only maybe $50. I go to a full service stockbroker that charges me about $200 or depending on the size of the trade, but at least $200 to $300 minimum, and then gives me some advice along the way. But I have a good understanding about how shares work and how a capital gain works and how dividends work and what have you. But I still get some guidance from my stockbroker. The key is that if you are not the type of person that can understand these complex scenarios with investments or even the complexity of running a structure like a self-managed super fund, you might want to think about whether it's really something you want to get into. So there are some really good benefits as well. What I do like about a self-managed super fund is that it gives you the option to actually make decisions yourself. So if you don't like the decisions or the performance of what your retail fund or industry fund's making, and you've got enough knowledge and you think you're going to do a better job and get a better return, fantastic. But the other thing as well is sometimes it actually can help reduce risk in your business. As an example, if you had a business where you were reliant on renting a particular space, your super fund could actually go and buy a commercial space, whether that's an office, a factory, or a shop, any sort of commercial property, and then operate and lease that property from your super fund. But everything you do needs to be on an arm's length commercials basis. But that's one way to go, hey, look, my self-managed super fund, I'm never going to boot myself out. You still got to make sure you always pay your rent on time, right? Just like any normal lease. Essentially, it gives you a lot more ability to go, I don't have to play the landlord putting up the rent heaps, which means that then I have to go and move maybe every 6 or 8 years, depending on how long your lease and option is. So there's a lot of good options like that. And it could even be that if you have a huge member balance, that you might want to look at the idea of having super, because the cost might be lower to run your super fund as well. Just remember that the minimum super balance really that you need is at least, an ASIC recommends $200,000. And then upwards from there, those costs of running your fund become less and less as a percentage. So what I would say is before you go and set up a super fund, there are a few key things that you really want to look at. How much time do you have to commit to this on a week-to-week basis? How much time do you have, and do you have that ability or want to do that? The second thing I would say is insurance. Looking at your current insurance and then looking at when you close your retail or industry fund and then coming over to a self-managed super fund, how is your insurance that you have within that fund going to be affected? What's the strategy you need to think about to still have the right insurance but then also not be paying more? My third point is, are the costs going to outweigh the benefits? If the costs are huge and you have a small member balance, just like that client I was talking about at the start of the podcast today, and you have a member balance of $50,000, you have a lot of ground that you need to make back up in the investments that you're going to make to then recoup those initial setup costs, but then also those ongoing costs. The fourth thing that I would say that you really want to consider is you want to do something different. You don't want to be in your industry fund anymore. Maybe you've got to consider other options. Is it maybe moving to a different industry fund or a different retail fund that has a better return or a better performance? Is it maybe speaking to your financial planner and saying, I want to do a wrap account, which still has a bit more flexibility and the ability to choose where you invest money in, but not as complex as running a self-managed super fund? So fourth thing is, what are the other options before you get to running a self-managed super fund? Understanding what are the returns going to be likely on every different avenue. And my fifth thing that I would say that you need to really think about is what goals do you have in setting up your self-managed super fund? What are the goals that you have in the next year and long term, 3, 5, 10 years in time? What are those goals and what do you want to achieve? So let's do a little bit of a challenge. If you had to rewatch this video or you have been writing down all the pros and cons, which one gets the highest score? If you get mostly guesses out of everything we've been talking about here, maybe you should have that conversation first with an accountant or maybe a financial planner about setting up a self-managed super fund. Have that conversation first and then take the next steps. But what I would say is if we did a quick test now, number one, do you have more than $250,000? A positive, like a pro, is yes. Number two, are you willing to take on the legal responsibilities as being the trustee and getting everything right? And remembering that if you get it wrong, you could be losing half your balance if your super fund becomes non-compliant, because the ATO will tax you at the highest marginal tax bracket on the whole balance. Number three, do you have the time, the support, the interest, or the willingness to actually want to set up a self-managed super fund? Number four, do you have the right skills to be able to do this? And when we talk about skills, the right investment knowledge to make investment decisions that are going to be meeting that sole purpose test of increasing your member balance in your super fund. And my number five test would be, are you okay with those additional costs of setting up the self-managed super fund year on year? Remembering it's going to be between $5,000 to $10,000 to run a self-managed super fund every year. Well guys, that comes to the end of our podcast today, and hopefully now you know a little bit more about super and what a self-managed super fund is, and it gives you a little bit more information and to help you be a little bit more informed. Ultimately, I don't want you guys to be another story like that client to start with who only has $50,000. It's just going to be a disaster, because when you set up a self-managed super fund and you roll all the money in, even if you decide to close it, it's just not as simple as just closing it. There is a lot of processes and things that you need to do before you close that super fund down. So don't be another story, be informed, and then if it's right for you, be another one out there who set up a self-managed super fund, just like myself. I've got one as well, and they can work really well for you, but it all needs to stack up before you go and do it. Thank you for watching, and remember, if you've got any content ideas that you want me to talk about, please drop us a note and we'd love to hear about it so then we can talk about it on our next video. See you guys, have a good one.